Good morning, everyone, and thank you for joining us for today's webinar. Europe is in a complex and unstable situation. The war in Ukraine has severe consequences also at political, geopolitical level, human and economic level. The global monetary tightening and the multiple constraints of the Chinese growth is a gloomy and give us a gloomy outlook. The possibility of a global recession becoming more clear. And today we want with an expert, with Grzegorz Sielewicz, and I hope I pronounce good your name. You are the head of research of economic Central and Eastern Europe countries at Coface. Hello, Grzegorz.
Hello, good morning to you, Antonella. Good morning to everybody.
Thank you. So today with you, we will try to have more clarity on the situation is going on. So Greg, I will start with one question. What Central and Europe countries are so far impacted the most by the war in the neighbor Ukraine?
Once again, good morning to all of you, and thank you for joining our webinar this morning. Thank you, Antonella, for your invitation, and thank you for your interest in Central and Eastern Europe. Antonella, answering your question, I think we, of course, could assess the impact from the economic perspective, but I guess you are fully aware what already happened yesterday, so that not one, but it seems that 2 missiles crossed the border with Ukraine. I mean, they fell into Poland, and unfortunately 2 people died because of the explosion. So we see, unfortunately, that the war applies not only to Ukraine, but we had also victims in neighboring Poland. So of course, I do not want to pretend to be a military expert or the political expert. I'm not such a person. I don't want to make any conclusions on that, if we should expect any further examples of that what happened yesterday. But nevertheless, we see that indeed this impact could be not only economical one for countries, but also from other perspectives. Here, as I said, I don't want to go into details, as the Polish government and also NATO members expressed the issue is under the investigation. So let's wait for official news. My suggestion is that not just follow the fake news, because I think there will be lots of fake news. But nevertheless, here also answering your question, Antonella, in case of countries which are impacted the most, let's keep in mind that this war started at the end of February this year, and we already expected that some countries will suffer more than others. Here, generally, Central and Eastern European countries are those ones which traded with Eastern markets somehow more than Western Europe. So here I mean Russia, but also Ukraine, Belarus, especially countries like those ones which are in the Baltics region. So Lithuania, Latvia, Estonia, the former Soviet Union countries. For them, especially for Lithuania, Russia remained the biggest export destination. Of course, part of these exports were the so-called re-exports. It was somehow a hub of exports coming from Europe to Russia. But nevertheless, we've seen that indeed this impact was quite strong, especially for Baltics at the beginning. Although, as you perfectly know, Baltics in last years, they became more focused on trading with Western Europe. Actually, they joined, for example, the Eurozone. Previously, of course, they joined the European Union. So it's not that they are only focused on trading with Russia, but here not only with Baltics, also with other countries, Poland, for example, with lots of export volumes in the food industry, in the agro-food sector, going to Russia. lots of companies already suffered from such an impact. And here I think we've already seen in those last months that lots of companies change their portfolio of clients, they change the structure of their exports. But of course, we have a huge deterioration. It's deterioration that it's not only for Russia, for Ukraine, or for the sanctioned Belarus, but also we see the deterioration of various countries, also in Western Europe. So that's another negative message for Central and Eastern European countries. And actually, if I can already start the presentation, I would like to start with that, what's happening in terms of the economic activity. Well, just yesterday, there were Eurostat released data for the GDP growth in the third quarter of 2022. So right now, we have half of year data coming that we could conclude the impact of the war in Ukraine. We had already first data for Q2 2022, where the war already was there in Ukraine. And we've seen that at that time, the impact of war for Central and Eastern Europe, but I would say also for Western Europe, was not a very deep one. Of course, lots of growth rates stopped increasing. The trend of the improvement was not as strong as previously, but the deterioration was not as large as previously expected. Now with this Q3 2022 data, and you have them on the right-hand side on the chart here with those green bars. Well, here, those are quarter-over-quarter growth rates. The picture is quite mixed, I would say. So first start with those countries which are on the top of this chart. And at the top of this chart, we have countries where the contraction of GDP growth was the strongest in Q3 2022. You can see that those are mostly Central and Eastern European countries. So Latvia, mentioned by me before as the one of the Baltic economy, but also Slovenia, Hungary, or the Czech Republic. They already suffered. But as I said, the picture is relatively mixed. You can see also on the bottom part of this chart that there are some countries which from Central and Eastern Europe which still delivered strong growth rates. I mean here mostly Poland and Romania, except of Cyprus and the small economy of Cyprus. Those were two economies that grew at the strongest rate actually in Q3. So as I said, the picture even for Central Eastern Europe is quite mixed. In this economic activity, I also wanted to mention the progress or development of last quarters, and this is what you have on the chart on the left-hand side. Well, with lots of colorful lines. I hope you can see something from that because there are lots of lines here. But well, here my intention was that to compare how particular economies are doing as relation to the pre-pandemic level. As the pre-pandemic level, we concluded here the last quarter of 2019, and this is this 100. As you know, the first impact of the pandemic, first lockdowns were very deep ones for various economies, and we had contraction. Although the pandemic is right now not so hot topic, not so relevant issue, I think it's quite valid also to compare the progress since then. As you can see, countries in Central and Eastern Europe, because except of Italy and Germany, we have other countries are only for Central and Eastern Europe here on this chart on the left-hand side. They already mostly gained back the pre-pandemic level of GDP somewhere in the first half of 2021 or in the middle of 2021. That was quite fast, as you can see. Well, in webinar today, we have lots of participants from various countries. I just put here an example of Italy and from Western Europe, Germany. As you can see, Germany is the economy that in last quarter, or rather, sorry, in Q2 2022, because we had some delay in releasing data in Q2, finally it got back the same level that it was before the pandemic. So Germany was much well, the rebound from these pandemic doldrums was much more delayed than in case of Central and Eastern Europe. In case of Italy, as you can see, it was the second half of 2021, so also later than than Central and Eastern Europe. If we would add to this chart, for example, the Spanish economy, even more dependent on the tourism sector than the Italian one, still they are below the pre-pandemic level. Well, but I'm supposed to speak more on Central Eastern European economies today. So as you can see, this story for Central and Eastern European economies remains relatively positive in terms of this chart. Well, mostly those lines are not accelerating so much like they did in 2021 when we had the recovery from the pandemic contraction. But depending on the country, roughly it is still the positive trend, with some exceptions here, like for example Hungary. And here indeed, when we take a look at Q3 data, as I said, negative growth rates in quarter-over-quarter terms were in Latvia, Slovenia, Hungary, Czech Republic. And I think, well, that's all from Central Eastern European economies. We do not have all figures right now, like for example for Croatia and other countries. But it seems that the economic contraction, we should expect the economic contraction. It was not so far in the last data. That's a very positive message, but we should be prepared that this economic contraction is going to come to us. We expect that in Central and Eastern Europe, we'll have a technical recession. As a reminder, a technical recession is that when you have at least of 2 quarters of negative growth. And already those countries I mentioned, like Latvia, Slovenia, Hungary, and Czech Republic, they entered a negative growth. It's likely that Q4 will be a further period of deterioration for them. Whereas I would expect that also, unfortunately, other countries in Central and Eastern Europe could join that club with a negative growth rate. So technical recession is very likely for Central Eastern Europe. At this stage, I think GDP growth in 2023 as an entire year is likely to be positive in a bulk of Central Eastern European countries. That will be weak. We are used to that Central and Eastern European economies should deliver growth rates something like 3, 4, or even 5%. In 2023, it could be 0.1, 0.5, or 1% at most, but it will be much weaker, as I said. Well, and in this picture, it's also very important what's happening in the global economy, because, well, Central Eastern European economies, they are mostly focused on exports to Western Europe. Especially Germany remains the main trading destination. But here, not only the war in Ukraine, but also indeed the slowdown in Western Europe. And actually in Western Europe, we expect that in 2023, as the entire year figure, will have a recession in both Germany and Italy, two very important economies of the Eurozone. So that will have definitely negative effects also on the CE region. And as you can see, whereas concerns relate to the global economy, after relatively still good 2022, it was the period of the slowdown, but 2.8% in terms of the global economic activity is still a relatively good level compared, for example, to pre-pandemic levels. That was mostly fueled by the first half of the year, and in various countries also the Q3 2022. As I said, we expect deterioration will come in next quarters. But as you can see, in 2023, from the global economic growth, we expect just 1.9%. As you can see, before the pandemic, in the previous decade, we didn't have such a low level. Actually, if we moved back, lower levels, or levels similar to that, were at the beginning of this century, or during the financial crisis of 2008-2009, where lots of countries, or rather almost all countries, were in recessions. Here, also concluding contribution that comes to the global GDP growth, those colorful lines or bars that you can see in this chart. Well, the biggest contraction, as you can see, comes from this dark blue bar. This stands for advanced economies excluding the US. So they are mostly Western European economies. Again, a negative message for Central and Eastern Europe, where the deterioration is for Western Europe. Then, of course, we cannot expect that Central and Eastern Europe will be growing strongly. Of course, we have countries like Poland, Romania, which are contributed significantly by household consumption, but still lots of countries depend on exports, and that's what's happening in the global economy. Lots of Central and Eastern European companies are included in various global supply chains, Western European supply chains. So again, the bleak outlook for Europe is a negative message for the CEE region. And here in this outlook for Europe, I think you know the story perfectly. Europe is much more exposed, for example, than the US for the energy crisis. Of course, talking about the US, higher prices, that we had those increase of prices of crude oil, of fuel, of natural gas, and that's also not positive for the US. But for Europe, which was and relatively still dependent on gas from Russia, on various commodities coming from Russia, next months are going to be challenging. Looking just at storage levels, because this is the factor that is important to assess the impact from the gas crisis that we could have. We combined here two charts. One of that, as you can see on the left-hand side, is the level of European gas storage tanks. That one looks, I would say, really good, because those data that come from the beginning of November already showed that several countries had their storage tanks levels at 100%. The EU average was 95%. There were some countries in Europe like Hungary, Latvia, that were below, that were weaker than others. But really Europe did a lot to have supplies of natural gas, as you know, and that was not so huge dependence on Russia, but imports, supplies of natural gas, for example, of LNG from Middle East, from the US. So indeed, those levels seem to be quite high. But we also compared those level of European gas storage tanks. What are their capacities, or rather, assuming very theoretical scenario that we do not have any other supplies in those countries for natural gas. So assuming there is no domestic production, there are no imports of natural gas, whatever the direction is, Russia or Middle East, the US, whatever direction. What would be the time to consume gas storages? And here, as you can see, the left chart with the gas storage tanks, so the capacities of gas storage tanks, is not the same that the consumption. The consumption would be the highest, so it would be the best for Latvia and Austria, so countries that were quite weak on the chart on the left-hand side. But for them, it would be roughly 1 year or more than 1 year that they could have this natural gas that they storage so far at this level. For other countries, like for example Poland, which is close to 100%, as you can see, that would be relevant only for 2 months, unfortunately. We have also in Western Europe some countries like, for example, the UK, which is quite weak, but here the domestic production is relatively high, and the UK didn't invest so much in storage levels, because once it was produced, it was not the necessity to store that. And frankly speaking, even those two charts are not very comprehensive of that what we could expect. This is huge uncertainty regarding the gas crisis. We are not sure what will be the winter, how harsh it is going to be, if those time to consume gas storage will be actually not as high, because companies, households will need more gas due to a very cold winter. We still do not know what prices will be. Okay, they is somehow compared to those very high levels that were triggered at the beginning of the war, but nevertheless the uncertainty here remains. So also the uncertainty from the gas crisis, the energy crisis, is still very valid for Europe. And then just finishing this quite well general European picture or global picture, which is very relevant for Central and Eastern European countries. We have the deteriorated mood and also deteriorated sentiment of industries here on the left hand side, expressed with this navy line with the PMI composite indicator. But what I wanted to put your attention is also the green line with the impact of output prices. I'm sure you perfectly know that prices of various components, commodities increased a lot, not only when the war in Ukraine started, but already before, when we had the recovery from the pandemic deterioration. And although that factor eased, as you can see, this green line remains on high level compared to previous years. So still, this more difficult access to various commodities, whatever they are, energy commodities or agricultural commodities, especially those two are impacted by the war in Ukraine, but also other ones. Still, although the access to semiconductors somehow eased, it's not that it's really the easy one, and also companies still suffer from shortages of various components and higher prices of various components. And that's, of course, still impacts prices. Prices are impacted mostly by higher prices of commodities like energy, also food. We've seen that in Western Europe, Germany, France perhaps not so much, but also their inflation is much stronger than previously. Italy, the US right now recording somehow lower inflation, 7.7%, that it was in previous months. It was 8.3 and then 8.2, but still it's much higher than it used to be in previous years. And here, going to more to Central and Eastern European countries, here on the left hand side you can see inflation for September this year. Tomorrow there will be released by Eurostat of inflation for October. We have already some inflation figures for October for Central and Eastern European countries, but here I wanted to show you how it looks like the comparison of the European Union countries. Or countries in general in Europe, because that's not only the European Union on the chart on the left hand side. And well, as you can see here, all countries from Central and Eastern Europe are unfortunately above the EU average. Inflation in Central and Eastern Europe is higher than in Western Europe. In countries like Baltics, we have already inflation above 20%. Is very high, is very negative for households. Here in Baltics, the impact of higher prices of energy commodities, of natural gas, it was almost fully transferred to households. That's why inflation there is so high. But even despite implementing various measures to limit this growth of inflation, in Central and Eastern Europe, as I said, we have really high inflation. The reason for that, one of the reasons, is that the so-called inflation basket is somehow different than in Western Europe. In the CE region, we have a higher share of energy and food component, those goods in the inflation basket, than in Western Europe. Then another factor is that lots of countries in Central and Eastern Europe are not in the Eurozone. So, of course, we know the story that the euro depreciated compared to US dollar, but various currencies in Central and Eastern Europe even depreciated more. Here I mean mostly Hungary and Poland. Perhaps you are aware, though, we have concerns of the European Commission regarding the rule of law on those two countries. And although news from last days assumes that it's likely that hopefully that those clashes will not be so intense, that those disruptions will be solved. Currencies, especially of those two countries, suffered. The level is lower than it used to be at the beginning of the year. For example, Hungarian forint is weaker somehow by 7 or 8% compared to the average level that it was in January 2022. And if you have depreciated currency, weaker currency, then you pay more for imports, for imported goods. If you pay more for imported goods, then it impacts the consumer inflation as well. And here in this also inflation picture in the CE region, let's do not forget, that in last several years, really several years, so something like 9 years, last 9 years, we had an increases of minimum wages in Central and Eastern Europe. Several steps of increasing minimum wages. For example, in last 5 years in Poland, the minimum wage increased by more than 50%. We have countries like Hungary where this increase was something like 80%. Of course, that's very good from the point of view of household. The convergence with the Western Europe should be going on, but that put a pressure also on the average level of wages, not only for those people that get minimum wages, but the pressure from all employees was very strong one, especially that the labor market in Central and Eastern Europe has been improving. It's still in a very good trend. Unemployment rates are very low. For example, in the Czech Republic, we have an unemployment rate below 3%, below the level than it is in Germany. And here, of course, if we still have a very good situation on the labor market. I think you lost the presentation, and at least I cannot see it. I don't know why was that. Let me try to share it once again. Sorry.
We can see your presentation. Huh?
You can see. Okay, so
yeah,
I do not see. Okay, I see it right now. Okay, so sorry, that was on my side some probably technical issue. Okay, so I was speaking about those minimum wages. So the favorable situation on the labor market in the CE region. So once you get this situation that is favorable, that also triggers demand, and if we have increased demand, that triggers also increase of prices. And I think those are the biggest reasons, the most crucial reasons why inflation right now in Central Eastern Europe is so high. So it is not only the consequence of the war in Ukraine, but also the consequence of those other factors. Well, and in such the economic environment, when there's a huge uncertainty, when people expect that indeed countries could go into recession in next quarters, when inflation is high, of course the mood is negative. Especially the mood is negative in case of households, in case of consumer confidence. You can see that on the chart on the right hand side, where we put here a few Central Eastern European countries, and you can see from the beginning of the year the contraction of the mood was deteriorating. Right now in some countries it's stabilized, in some countries like in Hungary it even went deeper, but here nevertheless for a bulk of countries, those are the levels that we didn't see in the past. Those are the lowest levels of consumer confidence in the history, and mostly those surveys started in 1990s. So indeed for last several years, for a few decades, we didn't have such a bad mood of the consumer confidence. Well, what's the response for the inflation? The most typical one, as we know from textbooks of economics, is that to increase in interest rates. We see that already from the large central banks, so the ECB, the US Fed. The US Fed was really the one that is very aggressive, but not only. Here you have also the examples of the UK and the Eurozone. And I think also from those large central banks, we could expect further interest rate hikes. And as you can see, the steepness of this curve, so this path is really very aggressive. It's not like it was in the past, that they react very, very fast and with relatively high increases of interest rates. But well, in Central Eastern Europe, central banks, those which are not in the Eurozone, they started to increase interest rates already before the ECB. We've seen that before the war, that once energy commodities prices are going up, they wanted to limit the growth of inflation. As you can see, especially Hungary made a very aggressive, very high increase of interest rates. Previously, they have the measure impacting, well, strongly limiting the increase of prices of natural gas, but that one right now was phased out, and we see that they wanted also to have an impact on inflation. It seems that despite the increased interest rates, inflation in Hungary is already at a double-digit level, not only double-digit, but it exceeded 20%. And also we have a roughly similar story in other Central and Eastern European countries. So despite the fact there were several increases of interest rates, for example, in last year, the Polish Central Bank made 11 increases of interest rates, 11 hikes of interest rates. Those were not sufficient to limit the inflation. As I said, inflation remains in double-digit levels. And well, here, as you can see, some central banks stopped increasing interest rates in Central and Eastern Europe. That's the case for Czech Republic and for Poland. Last two meetings were that they withhold increasing interest rates. Well, they could be afraid of dwarfing the economic activity, as the higher interest rates, of course, impact the cost of financing, and also the impact of increased interest rates. It's not seen immediately, depending on analysis. It could be 1 year, it could be even more than 1 year. So indeed, I think that for rate setters, it's a very difficult task right now. And please remember that they could more impact the core inflation. As I said, most of the inflation is impacted still by high prices of commodities like energy goods, energy commodities, food commodities, and those ones are quoted on external markets, on the global markets. So if, for example, the Polish Central Bank increases the interest rate, it has nearly nothing, it deals with not at all with the impact of the crude oil on the global market, or the natural gas quoted on global markets. They could impact more the core inflation. The core inflation is that one that is excluding energy and food goods. But here as well, it's a kind of paradox that after those all months, the core inflation is right now impacting more by indirect consequences of higher prices of energy, because companies already started to transfer higher prices of their production, higher prices of costs they suffer for final consumers. So indeed, I will repeat that I think it's not a golden rule here. If countries in Central and Eastern Europe, but also in other regions, should continue their monetary policy, should stop, it's really hard task for those countries.
Gregor, and when do you think the process of their lowering of these interest rates that are the highest in Europe will be started, and when should we expect they will be back to the pre-pandemic situation or pre-war levels?
Well, so far in next month we should not expect it. That I would expect that if what we can see right now, that some central banks indeed could join the same club like the Polish and the Czech one. So withholding, not increasing interest rates, but even for those two, depending on developments, then they could come back to increasing interest rates. Lower interest rates, it's perhaps in the baseline scenario could be the issue that will be done at the end of 2023. But here I think there are so many uncertainties that I would not be fully sure regarding that. I would not bet any money on that. actually. Everything indeed depends on inflation. I would expect that inflation could in Central and Eastern Europe could come back to one-digit level in the second half of 2023, hopefully. At least, for example, statistical base effects will play a role here when it will be the comparison already to high levels that we had in many months back. But here, even if we have inflation like 8-9% or even 6%, this is still much higher than the inflation target. Depending on the central bank, but roughly in Central Eastern Europe, we have inflation targets of 2.5% plus minus 1 percentage point. So something like 3.5% remains the upper band of the inflation target. So still those levels will be higher. I would expect that, as I said, in the baseline scenario, the end of 2023 could be this period that central banks could think and could start lowering interest rates, as they will care a lot regarding the economic activity that to support the economy from the monetary policy point of view.
And, thank you. And we hope that will be like this. Okay, okay. Go on, please.
And here, in terms of latest indicators coming from Central and Eastern Europe, so not only done what we have for Q3, but also for first data coming in also for next month, like for October, we see that indeed this is the slowdown, this is the losing momentum. Whatever we see, we take a look, retail sales or industrial production. This is the chart that you can see that it starts with 2019 roughly. You can see the contraction coming during the pandemic and in retail sales also, and other lockdowns in November, and also at the beginning of 2021 in Central Eastern Europe. We had also very, very deep lockdowns here in Central Eastern Europe. But what you can see recently, so the last months of those charts, is that the trend is not increasing. In some countries, like in retail sales, Czech Republic and Slovakia, those dark blue and yellow lines, they are rather negative, they are going down. The exception here is seems somehow to be Poland. Maybe the trend is not very positive one, but last month brought that it is not decreasing. Of course, let's remember here that in Poland we have still a huge share of refugees from Ukraine that also support household consumption, and we've seen that already in April, for example, data when there was a peak of the spending, but we still see that this consumption is relatively not only coming from from refugees, but also domestically. Although people are concerned, as I showed you, consumer confidence is low. They are more cautious with their spending. They are not spending so much money on durable goods, but nevertheless, it's not the deterioration that is in line with a huge drop of consumer confidence. In terms of the chart on the right-hand side, the industrial production, mostly we also approach here flat lines in last month, so it's not the deterioration, but it's somehow that it's stagnated. Here, of course, remember that industrial production is driven not only by domestic demand, but also by external demand. So what I said previously, especially Western Europe, but not only Western Europe, as lots of countries and lots of companies in Central and Eastern Europe are included in global supply chains. For example, in Poland is the location of one of the biggest factory of batteries to electric vehicles, South Korean company, and where the previous ideas were just to be a hub for factories, automotive factories in Central and Eastern Europe. Now it serves worldwide exports, and it was the factory was expanded, and so as a result, the impact coming from the global economy is very crucial also for the industrial production in the region. Of course, here, as I said, another confirmation from PMI indicators on the left-hand side. We have a deterioration not only in Central Eastern Europe. Here examples of the PMI indicators for Czech Republic and Poland, but also on crucial Western European destinations for Central and Eastern European countries. As you can see, after this recovery of the pandemic, where PMIs were really strong, we had a deterioration that roughly started in February this year. So when the war in Ukraine started, and as you can see, all countries here are below 50, and when it is below 50, it is considered as a slowdown. And well, as you can see, we didn't have it in past months. Those are the levels that are quite comparable to the pandemic contraction, not so much like in the first wave of the pandemic, but nevertheless very weak levels of PMIs, so lots of concerns also from this side. And here also on the right hand side, I showed you on the global activity that somehow this shortage of inputs eased on the global scale. It also eased on the scale in Central and Eastern Europe. This is the chart that you can see on the right hand side, but it remains relatively high compared to previous ones. So here, especially in the Czech Republic, the economy very dependent on the automotive sector. So still it suffers, for example, for various shortages in vehicle production. And it's not likely it's going to be reversed. Here, the last sentence on that, let's remember that still China is focused on its zero COVID policy. And that means that various supplies to Europe could be limited if they still implement various lockdown measures. This is what before the pandemic already threatened us in case of supply from China. But as you remember, this was also another factor with supply chain disruptions in last months and last quarters. But it could be valid still again. So let's also monitor that factor. And then finally, coming somehow more to the end of my presentation, various microeconomic issues, because at Coface we care not only about macroeconomics but also microeconomics to check what's happening with companies' liquidity situation. And well, basically in the C region, here you have two examples for Czech Republic and Romania. We have paradoxically a good situation with insolvencies. I mean the decrease of business insolvencies in 2020. I said paradoxically because with such an extended crisis like the pandemic triggered, we should expect a surge of insolvencies. But I guess similar to your countries, to countries that you are based, because that was the worldwide trend, we had implemented the governments, or there were also quasi-governmental measures implemented to limit the negative impact for companies. And that's why, as I said, paradoxically, we had a decrease of insolvencies thanks to this factor. But as you know, those measures were already phased out. There already are some measures for energy-intensive companies in various countries to limit the impact for them of the surge of energy prices, but nevertheless the extent, the scale of support measures is not as big as it was previously in countries, and the same is in Central and Eastern Europe. So facing that, we see that already business insolvencies in the CE region started to increase. As you can see in those two examples, Czech Republic and Romania, roughly they are the same or even above, like in Romania, the pre-pandemic level. So here, those first half of 2019. And we have similar situation in various other countries. Like, for example, in Poland, it's even stronger than it was in 2019. In Poland, we have a different situation because we have not only insolvencies, but also restructuration proceedings implemented in 2016. Also, in the middle of 2020, we had special dedicated proceedings implemented as a part of the so-called COVID-19 Act, but I wouldn't like to waste your time right now because it's a very deep subject, so we would need something like 20 minutes to go deeper. If you have any interest, please contact me regarding that. I will explain you, but the reason is that, well, the conclusion is that we have a lack of payments for the counterparty, whatever in Poland it's insolvencies, restructuration proceedings, or those very fast measures not announced by courts that are not in the chart here. And here, as you can see, those levels, combined levels, are relatively high. And also on the left-hand side, you can see average payment delays, which comes from our payment survey. We are now working on the next edition of the payment survey. We are just collecting answers, so it will be released soon. But so far, you can see this on the left-hand side. This is the one that we released at the beginning of this year, so before the war in Ukraine. And already at that time, as you can see, the average payment delays in Poland increased, and that was valid for a bulk of sectors. And this 56.7 days that you can see for average was very close to 2019 levels, where it was 57.2. So again, coming back to pre-pandemic levels already at that stage. Right now, with lots of challenges, with lots of uncertainties, we expect that this payment liquidity situation is quite triggered, although it's so far it's not so much reflected in long payment delays. It's more that some companies just are going out of the business due to the difficult situation, and we see that in restructuration proceedings. And as the last point on my side, at Coface, we do country and sector risk assessments. Perhaps we are familiar with this tool because we like to share that in our quarterly barometer publications. And untypically, because usually I share those assessments for the last update, but untypically this time I would like to share assessments for not only last but also previous quarter. This what you can see here is that what we did in the middle of 2022, and at that time, concluding all those factors, all those uncertainties, concerns, challenges for Europe, and also not only on the macroeconomic side but also on the microeconomic side, we downgraded lots of countries in Europe, including Central and Eastern European countries. As you can see in this magnifying glass on the left-hand side, there were lots of countries downgraded, including the C region like Poland, Czech Republic, Slovakia, Baltics as well. So indeed, we've seen that the contraction is there already, and our tool is somehow forward-looking, so we should follow that. Then you can see the latest assessment that we published last month for after Q3 2022, and here other countries from Europe unfortunately joined that, including Italy, which was downgraded to B level, not from Central and Eastern European ones because all the downgrades were made before, but here a negative message also for the C countries, that other countries which were not downgraded from Western Europe were downgraded this time. And in terms of sector risk assessments, sorry, because I forgot to mention that perhaps you are not aware of those country risk assessments, so just a few words more on that. This is the tool that we use focusing on the corporate risk. So it is not the same that rating agencies do, that they focus on sovereign risk. Of course, we take into consideration the similar factors that rating agencies, so like the economic situation of particular country, financial situation, or the political situation, but we add to that our payment experiences, views of our underwriters, and also business climate assessment. And as I said, this is focused more on the corporate risk. The assessment comes from the A1, very low level. Right now, it's roughly only we could say Norway with its gas resources, not other countries with so high with so low risk level. The assessments are A2, A3, A4, and B, C, D, E is extreme risk. And in case of sector risk assessment, the scale is 4 grades: low, medium, high risk, and very high risk. And well, again, the same comparison. So first, in the middle of 2022, we already did at that time downgrades of sectors, various sectors in Central and Eastern Europe in Central and Eastern Europe. Those energy intensive, like the chemical sector, the wood sector, also the transport sector, which suffered already from the impact of demand that started to slow down, but also from higher prices of fuel. Lots of transports in Central Eastern Europe is done via road transports, and even we have the crude oil price, the Brent oil price, not as high as it was in February and March 2022. Still, fuel prices are much higher than previously, and that's a negative message for transport companies. Also, as I said, in the sea region, we have higher interest rates. Higher interest rates impact the financing costs, leasing costs, and right now we see lots of companies complaining on that leasing costs for them increase so huge that they are not going to, it's not possible for them to continue their business activity because costs are just too high. And last but not least, still labor shortages in the transport sector in the sea region is very high, and that also suffers and put a pressure on higher wages in the sector. Well, then in last time we also did another downgrades for the energy sector in Central and Eastern Europe, but also another energy intensive ones like paper, but also here, as you can see, the retail sector. So although, as I said, perhaps the contraction is not so big, nevertheless, for various retail companies in the sea region, this high inflation, the factor that households are not so willing to spend money on durable goods, that some of them, even for daily necessities, they choose cheaper goods. They substitute they spending with cheaper goods is negative. Of course, for some companies, this substitution could be a good factor if they are present in this segment. But overall, for the retail sector, we see that indeed this contraction, perhaps it's not so far very deep, but we expect it will be next month. So as I said, those tools are somehow forward-looking. That's why we downgraded also the retail sector in Central and Eastern Europe. Well, so that's on the side of presentation on this economic activity. I hope that was interesting. Well, Antonella, I give floor to you.
Thank you very much for your presentation. It was very, very interesting, and thank you to all of you for your attention. To conclude your outlook, I just ask you one question. You talk about a lot of factors affecting the Central and Eastern Europe countries. So, what are the biggest challenge that this country has to face, and also one word of positive for your point, personal and professional view on the overall situation that we are facing.
Yes. Well, so in case of those challenges, I think that it's not only the war in Ukraine, so that country is very close to, lots of countries are closer than Western Europe to Ukraine. And also we could expect that, for example, foreign investors could be reluctant to invest so much in Central and Eastern Europe that they did in the past, as they will be afraid of that. On the other hand, and I think that also leads to somehow positive message, if they are not very concerned, still the region remains very competitive in case of not only Western Europe, but also on the global scale. Let's keep in mind that the pandemic realized us that we should not be dependent so much on one destination of imports. Here I mean China. Of course, I wouldn't like to put here any conclusion that China will stop be the biggest supplier of components and final goods to the world. They are very competitive. They can produce and export huge volumes. But here I think also this is the opportunity for the Central and Eastern Europe. Lots of them are in the European Union, so the legal framework is roughly the same like in the Western Europe. Still, they are very competitive. So despite the fact I told that wages went up in Central and Eastern Europe, they are lower than in Western Europe. This is here we have a really educated workforce. The infrastructure improved a lot, so lots of those foreign companies they are still likely to invest if they are not concerned regarding the situation in Ukraine, and that's what we have this negative message that from yesterday that missiles came across the border with Poland. Still, I think that's the chance. And more to that, finishing with as you said, Antonella, more with a positive tone, because I think lots of the outcome of that, what I said, was negative. I would also say here that let's take this example of the pandemic. You know how negative we were at the beginning. We expected really deep recessions in 2020. Of course, there were recessions, as we've seen in some countries, like for example Spain. We still have the rebound process is still going on, but it's not full. But finally, it seemed that companies and households adopted to this new situation. We adopted also to different style of working from home, but companies also adopted to more difficult access to various components. And I think this is the positive side, that whatever is the situation, companies and economies adopt. That first estimations, first forecasts could be too negative, whereas the final outcome could be not so negative. And let's hope it will go this way.
Thank you very much, really, for this important update. We are closing now the webinar. Thank you for your participation again. I wanted to remind all of you that you are going to receive the presentation and also the recorded version. And I invite right now Grzegorz for another update in the coming months, because it was very useful. Don't forget to follow us on the social media and on our website for the economic update, and also remember that we are here for building business together. So thank you very much. Thank you again, Grzegorz, and at the next webinar.
Thank you. That was my great pleasure to provide you with our views. So thank you and have a good rest of the day. Goodbye.
Goodbye.